You're in the room, you've pulled up your cover slide. Instead of the engagement you expected, you're met with a heavy, silent delay. In an attempt to look like a billion-dollar company, you've cluttered your mission statement with buzzwords and listed a dozen features. You're stretching the numbers to seem larger than you actually are. You think you're signaling ambition, but an investor's brain defaults to an automatic rejection response. This is a fast, instinctual judgment that filters out noise before the rational mind even engages. Stretching numbers signals intellectual laziness. It suggests a founder hasn't done the difficult operational math required to build a real business. The data shows that the habit of inflating numbers often ruins the first major proof point of the pitch, the market sizing slide. This chart shows market layers: TAM, SAM, and SOM. Founders often cite a massive, multi-billion-dollar TAM, claiming they only need 1%. This top-down logic ignores the real friction and cost involved in acquiring your first cohort of customers. Investors look for a bottom-up methodology instead. You determine your serviceable, obtainable market by multiplying the exact number of users you can realistically reach by your average revenue per user. A smaller, mathematically defensible market size builds more trust than a massive, unproven dollar amount. The financial slide reveals how deeply a founder understands the levers driving their business. Many decks show a smooth revenue curve climbing to $100 million. These straight-line projections lack real pricing logic. In response, investors mentally add a cash burn line, searching for realistic operating expenses the founder might be hiding. An investment-ready financial slide follows a specific structure: a clean 3-year bar chart, a visible cash runway bar, and key assumptions clearly listed. Placing assumptions like CAC and LTV directly on the slide allows an investor to mentally test the sensitivity of your model in real time. Investors use these projections to measure a founder's operational grip on reality. Funding decisions are rarely made during the pitch itself. Most often, the final call happens 48 hours after you've left the room. Your investor has to write a partner memo, a formal document designed to convince the rest of the fund's partners to invest. A story an investor can repeat is worth significantly more than a slide they have to reread. This is the screenshot test. If a slide is cluttered or the math is stretched, an investor cannot confidently include it in their internal memo to support the deal. A pitch deck's primary function is to arm your internal champion with the exact evidence they need to convince their partners. Open your pitch deck right now and subject your cover slide and financials to the screenshot test. To automate this process, you can use our slide-by-slide VC instruction guide. It includes 16 AI prompts built on real investor psychology to ensure your narrative stands up to boardroom scrutiny. Fixing your narrative architecture is the most direct way to ensure your business survives the initial filtering process.